In this recording, we're going to look at the sale of long-term assets. Previously, we've gone over buying long-term assets, allocating depreciation, subsequent expenditures, and now we're here at the end when we are actually either selling or junking or whatever, but getting rid of a long-term asset. So let's go forward through our notes. Here, sale of equipment. So here's a little demonstration problem. O'Brien Service Company purchased a machine on January 1, 2017 for $5,000 plus a delivery charge of $200. So that gives us a total cost of $5,200, right? We would not expense the $200, we would capitalize that cost as an asset. So originally, way back in 2017, the company put $5,200 as cost in the equipment account. Brian plans on using the machine for 4 years and has an estimate of $1,200. So every year end, on December 31st, the company took the original cost of $5,200, subtracted the salvage, what they estimate they'll sell it for, and divided by 4 years. So that gave us an annual depreciation expense of $1,000 each year. So let's go to our accumulated depreciation account. Recall it's a contra asset, so it goes up with credits. So at the end of 2017, we would have $1,000 in there. And then at the end of 2018, we would have put in another $1,000. And then also at the end of 2019, we also would have put in another $1,000, right? At each year end, there would have been a debit to depreciation expense and this credit to accumulated depreciation. I'm only focusing on the credit to accumulated depreciation. So, on January 1 of 2020, there's $3,000 balance in accumulated depreciation, and we still have this original balance in the equipment account for its original cost. So we jump into mid-year. So in the middle of 2020, Brian sold the copy machine for $1,400. Well, the first thing we need to do is update depreciation expense to June 30th because that's the time of the sale. So we want to update depreciation expense. So our standard journal entry for depreciation is to debit depreciation expense. Right? Expenses reduce retained earnings. That's why they're debits. Now, we only have half a year. So if a whole year's depreciation is $1,000, a half a year is $500. Okay, and then the credit is to accumulated depreciation. The accumulated depreciation account is a contra asset, causing assets to go down. If you cause assets to go down, you have a credit. Now let's post that credit to accumulated depreciation. So at this point in time, on June 30th, 2020, we have an updated balance in the accumulated depreciation account of $3,500. Now we can record the sale. So cash comes in, right? And we give up the equipment. So let's record cash coming in. If cash increases, right, that's a debit. So we debit cash, $1,400. Now, here's what we have in our accounting system for the equipment. These accounts should be zero after we sell the equipment. So we want to bring these balances down to zero. So I can do that by, right, the accumulated depreciation. To zero it out, draw a line there. To zero it out, I need to debit it. And I'm just going to abbreviate it ACCDEP. But I'm going to decrease that account. I'm going to decrease accumulated depreciation, $3,500. And if I debited that here, that would create a zero balance in the account. Over here with the equipment, right, to zero it out, I need to credit it. So I would credit equipment the $5,200. Now, if I net these two numbers together, $5,200 and $3,500, that actually gives us a book value, right? In the accounting records, which used to be books, there's a book value of $1,700. Cost of $5,200, accumulated depreciation of $3,500. Those net to $1,700. So if we got cash of $1,400 and we give up book value of $1,700, we actually have a $300 loss. So we want losses are like expenses, they're debits. So loss on disposal of plant asset. Loss on disposal of plant asset. 300. And if I add up all my debits, these all total $5,200, and I have a $5,200 credit. Now, I did a what if. Instead of selling it for $1,400, what if O'Brien sold it for $2,000? Well, I still have the first step, and I'm just going to abbreviate depreciation expense this way and accumulated depreciation just to speed up everything. So I still need to go through the same first step of updating for 6 months of depreciation. The second step is similar as well. Cash comes in. This time we get $2,000. I want to remove what's in the accounting system, so I'm going to decrease my accumulated depreciation account for its balance of $3,500. I'm going to decrease the equipment account for its balance of $5,200. And again, that's a net book value of $1,700. I'll just do BV here for book value. So if I sold the equipment for $2,000, it has an accounting book value of $1,700. This time we have a gain. Gains are like revenue, they're credits. So I'll create an account called gain on disposal of plant asset. And notice my debits total $5,500, my credits total $5,500. So this is similar to what you did in the Wiley Plus assignment before class. The main difference though is this is a sale during the middle of the year. I want to jump forward. Let's skip through this financial statement analysis. We will get to that another day. I do want to talk about one more topic with depreciation. Depreciation, by definition, is just taking the cost of a long-term asset and allocating it systematically, rationally, over the periods benefited, which we've been calling its useful life. How long are we actually going to use the asset? So we have seen in accounting where if we record something as an asset, as we use that asset, we turn it into an expense, a cost into an expense. Now, with the O'Brien example, it was a 4-year asset, and each year was $1,000 of depreciation, right? So it would look like a flat line. That's called the straight line method of depreciation, and it's pretty straightforward and easy to do. However, there are other methods. We're not actually going to get into the calculations of these other methods, but I do want you to be aware of there are accelerated methods. So in addition to straight line depreciation method, there are various accelerated methods. For instance, in one accelerated method, if we did the calculation, we would actually have $2,600 of depreciation in year 1, $1,300 of depreciation in year 2, and about $100 of depreciation in year 3. Look at what that line looks like. That's why it's called accelerated, meaning lots of depreciation expense early on, we accelerate it, and then it will decline over time. But in both cases, if I add up total depreciation or accumulate the depreciation over time, I would get $4,000 under the straight line method. If I take 26 plus 13 plus 1 under the accelerated method, I also would have $4,000 of accumulated depreciation. So it's just a matter of how do I allocate it? Do I allocate it evenly, or do I allocate more expense early on? One of the reasonings for an accelerated method is that with the theory is that we actually use the asset more early on in its life, and we get less use out of equipment later on in its life. So it does have a theoretical basis for it. Now, one of the things about accelerated versus straight line method has to do with income tax. Now, we saw some impacts of income tax when we studied costing for inventory. We saw FIFO, LIFO, and weighted average. For the financial statements, the Financial Accounting Standards Board says we can use FIFO, LIFO, or weighted average. The IRS, so here we have the FASB, Financial Accounting Standards Board, overseeing the financial statement rules. We have the IRS overseeing the tax law. The IRS code says we can use FIFO, LIFO, or weighted average. So I can use any of these for financial statements or for income tax purposes. However, when we get to property, plant, and equipment or planned assets, the FASB uses straight line, and it has a particular accelerated method. This is called double declining balance, and it allows that method. For tax law, the straight line method is also used, but there's an accelerated method created by, well, actually I guess Congress and the IRS enforces it, called MACRS, Modified Accelerated Cost Recovery System. It is extremely accelerated, extremely fast depreciation. This accelerated method is so fast that the FASB does not allow it to be used for financial statement purposes. Okay, well, I want to go look at a common strategy is to use straight line for financial statements and an accelerated method over here for tax purposes. So let's look at what would that look like. So here I've got a setup for the income statement if I use straight line. And again, remember the $1,000 each year in our O'Brien example. I just made up. So keep in mind, remember, it had a cost of $5,200, and then if you subtract the accumulated depreciation, you would get a book value of $4,200, $3,200, $2,200, and then at the end, $1,200 book value. Let's assume we have $3,000 income before we factor in depreciation expense and income tax expense. So then if I subtract my depreciation expense, I'll get the income before taxes, and that's the income we pay income tax on. So at a 30% rate, right, 2,000 times 30%, my income tax expense is $600 each year. And then, net income, $1,400. Now, let's mix it up. Same sort of thing, where we have the same income before depreciation and taxes. If I use the accelerated method, I still have accumulated depreciation of $4,000 over the life of the asset. However, I'm going to get different numbers throughout over here. So $3,000 minus $2,600. This time I only pay tax on $400. This is for my tax return that I fill out for the IRS. So instead of income tax expense, this is the actual cash I pay. Notice in the long run, the totals are always going to be the same in the long run. But in the short run, we will have a difference. So let's go in and look at that. So in year one, we would have $600 of income tax expense, but we're only going to write a check for $120. So we would have cash savings the first year of $480 by using this strategy. Straight line depreciation method for the income statement, but an accelerated method for our income tax return. Let's go to the next year. Year two, again, our expense is $600, and we're going to see that to be the case all along, right? Income tax expense will be the same each year. What's going to differ is how much we write our check for to the IRS. So in year two, we write a check for $510. Again, I have cash savings of $90. Let's accumulate these savings. So let's look at the accumulation. So year 1, 480. Year 2 was 90, so now we've accumulated to $570 total cash savings. Now, what happens in the third year? In the third year is where we hit this, where things start to turn around. So we're going to see income tax, we're going to see depreciation, 1,000 versus 100 turn around, and we will see income turn around and income tax is paid turn around. So now we're going to pay $870. So we actually pay more than our expense this time. So we have a deficit of $270. So we had accumulated cash savings of $570. Now we have a cash deficiency of $270. Accumulated goes down to $300. The last year, cash payment is $900. Notice that we lose here $300. We pay more than our expense, and that nets to zero. So the interesting thing here is that we actually kind of have an interest-free loan, right? We get cash savings, but we get cash savings, but we turn around and pay it back in the future. So in effect, Congress created an interest-free loan, oddly enough, by using depreciation methods. Okay, anyhow, I just wanted to expose you to the idea of an accelerated method, so you need to understand conceptually what's going on with an accelerated method versus straight line. And that's all the farther we're going to get. You do not have to do calculations for an accelerated method.